Good evening everyone. Welcome to JAIIB CAIB English Medium channel. Hope you all are doing well. So today we are having our Indian economy, Indian financial system session in which we will be talking about module D. So this is the session related to target series, and the target series have already completed module A, B and C. And now we are discussing module D, and in module D we will be starting today unit number 33. So module D of yours in IFS is the biggest module which covers around 17 units. And definitely these units are very big. So accordingly we have to cover the module D. Its weightage is high because it's have a lot of concepts in it, right? So module D start with the unit number 29. Today we will be talking about unit number 33. And this unit number 33 talks about the foreign exchange market. So in unit 29, we have discussed the financial market, and in the financial market, we have discussed the segment of financial market. That was money market, capital market, your Forex market, derivative market, debt market, credit market, insurance market. A lot of types of or the segments of financial market we have discussed in that chapter. And in every unit of module D, we have to cover the individual chapters in details, right? So today's session is all about foreign exchange market. So let's understand what is a foreign exchange market. So before moving forward, if we talk about the foreign exchange, what actually the foreign exchange is? Foreign exchange simply means exchange of currency. Whenever we exchange currency from one to another, that is called as a foreign exchange. Like if I am converting rupee into dollar, dollar into euro, euro into yuan, yuan into renminbi. So whenever we convert the currency or conversion of the currency is actually the foreign exchange. And the rate at which we exchange the currency is called as a foreign exchange rate, or we can say exchange rate, right? So now you can see foreign exchange markets are very deep and wide with present flow totaling $6.6 trillion per day. From where this market need or from where this Forex market have evolved? So we have seen every country have done the globalization. Globalization means opening your economy. In globalization, we allowed the cross-border transaction of everything, cross-border transaction of goods and services, capital, labor, apart from that, technology, your skills, your culture, your knowledge, everything is allowed to be done the cross-border transaction once the globalization have been done. In India, the globalization happened in 1991. That was the LPG policy we have studied in module A. In the economic reforms chapter. So now once the globalization have been done by every country, now every country is performing cross-border transaction of everything. Now because of that, we have the need of foreign exchange, because once you are doing a cross-border transaction, definitely you have to have a currency exchange. If we at India is doing any exchange or any transaction with USA, so we have to have a same kind of currency or same kind of product or service that can be exchanged by both the countries. But India have a Indian rupee, US have a US dollar. So that's why we have to exchange the currency so that the equal value will be get in that particular currency. And that's how the foreign exchange market, or we can say the foreign exchange requirements, have been increased in the economy. So you can see there are numerous types of participants, and the market is characterized by being global in nature, with no boundaries and no borders. So it's not like only India is the country who has done the globalization and who is performing the foreign trade. No, all the countries are doing the same. So that's why this Forex market is a global market, we can say, or it's global in nature. There is no boundaries, no borders. There is no such kind of condition regarding the boundaries. So being primarily, it is a over-the-counter market. Over-the-counter market means the parties can perform the transaction with each other. No mediator is required, and the new products like foreign exchange retail or FX retail platform was introduced by RBI. So FX retail platform is also called as a Forex retail platform, or you can call it a foreign exchange retail platform. This was introduced by RBI for the purpose of involving more and more people in the foreign exchange market, right? If you want to make the foreign exchange market big, if you want to get the benefit out of it, so more and more people should be participating in this market. And that's why the FX retail platform was introduced by RBI. That is also called as the Forex retail platform. Okay. So simply this was introduced, have emerged to give customer far deeper reach into the market. So we wanted to increase the reach of the Forex market. We wanted to make everybody capable of participating in the Forex market. Now, profile of foreign exchange, like when we talk about foreign exchange, we always say that foreign exchange is simply the exchange of currencies, right? Exchange of currencies called as what? It's a foreign exchange. But here, when we are talking about the foreign exchange, the FAMA, Foreign Exchange Management Act 1999, under the section 2N defines the foreign exchange. Okay, so what is FAMA? FAMA stands for Foreign Exchange Management Act. So the foreign exchange in our country is actually regulated or managed by the FAMA. So in 1939, first, we have introduced the Defense of India rules. Sorry. Then in 1947, we have introduced FARA, that stands for Foreign Exchange Regulation Act. Then in 1973, we have seen FARA again. So FARA 1973 replaced the FARA 1949 because of the being more comprehensive approach now. And after that, in 1999, we have introduced the FAMA, that stands for Foreign Exchange Management Act. So earlier, the Defense of India rules were there, which was regulating the forex market of our country. Then FARA was introduced, Foreign Exchange Regulation Act, in 1947, which used to have a lot of restrictions, regulations on the foreign exchange. And then the 1973 FARA came, which replaced the 1949 FARA. And by replacing that, we can say that more comprehensive approach have been used here. Then in 1999, FAMA was introduced, that is Foreign Exchange Management Act, that's called as a FAMA, right? So this was introduced. So foreign exchange means foreign currency. Okay, so section 2N of right now, RBI uses the legislation FAMA Act 1999 to manage the foreign exchange of our country or to regulate the foreign exchange of our country, right? Do remember that. So under the FAMA Act, section 2N defines the foreign exchange. It says that foreign exchange means the foreign currency, which includes first deposits, credit, balance payable in any foreign currency. Then draft, traveler check, letter of credit, bills of exchange expressed or drawn in Indian currency but payable in any foreign currency. Then draft, traveler check, letter of credit, bills of exchange drawn by banks, institution or person outside India but payable in Indian currency. So you can see every time, whether we are talking about the first statement, second or third, they all are talking about paying in the different currency. If it's in foreign currency, it will be paid in Indian currency. If it's in Indian currency, it will be paid in the foreign currency. This is what we are talking about here. The exchange of currency is your foreign exchange, and in any transaction which is happening in these 3 points, they will be called as a foreign exchange. So foreign exchange means foreign currency and include all such kind of transaction where we have to convert the currency or the conversion of currency have to be done. Okay. Now, forex market has developed as a consequences of the international trade and foreign exchange requirement of nation. So it is primarily an over-the-counter market, although there are exchange traded transaction as well as in the segment of future. So over-the-counter market is there. Over-the-counter market means directly the parties are exchanging their currency, no mediator is there, the parties are deciding their terms and conditions. That's a over-the-counter market. If we talk about exchange traded market or exchange traded transaction, it involves the mediator, that can be a stock exchange or any other mediator, who is performing the foreign exchange transaction between the two parties. So that's the difference between the over-the-counter market and exchange traded market. Now there are some characteristics of forex market. So first we have liquidity. The first characteristics is liquidity, second is promptness, third is availability, fourth is flexible regulation of the trade arrangement system, fifth is value, sixth is one valued quotation, seventh is market trend, and eighth is margin. So first, when we talk about the liquidity, liquidity means cash flow simply, or when you are using the forex market, when you are participating in the forex market is a liquid market because it deals in the currency, and currency is obviously a liquid statement we are talking about. So it have a liquidity. You can easily convert it into money. Then promptness is there. You do not have to wait for any transaction or any response or anything for 24 hours or some other days. No, it have a promptness, like immediate response will be given to you. Then we have availability. The market is available 24/7 because it's a foreign exchange market. Then flexible regulations are there. It's not like fixed regulation or rigid regulations are there. Flexible regulations are there. Because of that, the market is more known now. Then value, we are talking about the value. That means simply whenever we talk about the foreign exchange, it actually calculates or it actually performs a transaction of a value exchange. Then one valued quotation is there. Every time whenever we are performing the foreign exchange transaction or foreign market transaction, they actually depends on the exchange rate of a currency, right? If I say $1 is equals to 85 rupees right now, so according to that exchange rate, the quotation of everything will be given. So that's a one valued quotation. Market trend, understanding the market trend of foreign exchange or foreign currencies are helping us out to manage or to control the uh, chances of risk and to manage the chances of risk in the forex market, because it's a liquid market and it's a market that have a lot of variables, lot of variants are there. It's a floating market. The prices are keep changing, the exchange rate is keep changing, so it continuously changing. So at that time the risk is high definitely, and that's why the studying market trend and understanding the market trend is helping us out in minimizing the risk in the forex market. Then margin, a certain margin have to be maintained by the participants so that there is no such kind of risk have to be faced. Now we have market participants. In case of market participants, definitely we as an individual will be participant. So individuals will be there. Okay, you, me, we can participate. Then all the central banks of the countries will be there. Then apart from that, commercial bank, investment banks will be there. Sovereign funds are there. What are sovereign funds? These are the public investment funds which that invest proceeds from the business privatization, natural resources in the foreign currency asset. So sovereign funds are what? They are those public investment funds which actually have been earned by doing the business privatization or by selling the natural resources. And whatever proceeds, it means whatever money comes from these two sources, it will be invested in the foreign currency asset. That's the sovereign funds. Apart from that, hedge funds and investment entities are there. These are those entities which intervene in the foreign exchange market with speculative purposes or to obtain returns. Okay, so whenever we talk about the hedge funds, they want the maximum return, and to get the maximum return, they are ready to take a risk. So these are those entities, these are those funds who invest in the forex market for the speculative purposes. Speculative purposes, they are targeting the higher returns in the future, and to obtain the returns. So simply that is the market participants who participate in the forex market or in the foreign exchange market. Okay. Apart from that, next we have here the alternate reference rate, or we can call it a Libor. Okay. So when we talk about the Libor, it stands for London Interbank Offered Rate, and this London Interbank Offered Rate is actually used to be there when the global banks used to exchange their funds. Like I guess every one of you have heard about the money market. Money market is a simply short-term market where the exchange of funds will be done. Okay, and for the short-term period only it will be done. So Libor, London Interbank Offered Rate, used to be the rate which have been taken as a benchmark rate as well. So whenever the global banks used to exchange funds with each other, they used to charge the Libor. And also Libor have been taken as a reference rate or as a benchmark rate to decide the rates of other instruments as well. Like you can see, London Interbank Offered Rate was very popular benchmark and was issued for US dollar, British pound, euro, Swiss franc, Canadian dollar and Japanese yen. Okay, for all these currencies it used to be issued. And the rate was being calculated and published each day by ICE benchmark administration. So every day this used to be calculated. But somehow it come into the great amount of criticism and irregularities. So what type of criticism was there? That the transparency is not there deciding at the time of interest rate. And a lot of global banks which were involved in the ICE benchmark administration, they were deciding the rate of interest on the basis of their benefits. So such kind of criticism have been seen, and also this have been removed by replacing it from the alternate reference rate, because a lot of criticism and lot of objection was there during the Libor. And the Libor used to be as a reference rate, like if you talk about foreign currency convertible bonds, we used to check the Libor rate to decide what should be the rate of the foreign currency convertible bonds. For the lot of derivatives, we used to take Libor as a reference rate. For external loans, we used to take Libor as a reference rate. So it used to act as a reference rate as well, but it have been replaced now. So alternate reference rate replaced the Libor. Alternate reference rate stand for ARR stand for what? Alternate reference rate. It replaced the Libor. Okay. Now what is important in this chart? The first line is very important. This row is very important. The USA's alternate reference rate is named as the SOFR, Secured Overnight Financing Rate. UK's is named as a SONIA, that is a sterling overnight interbank average rate. EU's named as a euro short term rate, ESTR. Switzerland named as a SARON, that's a Swiss average rate overnight, and the Japan named as a TONAR, that is Tokyo overnight average rate. Out of these 5 alternate reference rate, we have SONIA, SARON and TONAR. They are very important, and SONIA even asked in maximum of your JIB paper. Even in May 2025 it have been asked, Hana? So do remember that we remember the name of the alternate reference rate of a country. SONIA is very important out of all of this. So now because the time is very less, I have a paid class from 7 p.m. So I will be ending the session here with the one question only that says, which of the following are not participating in the Forex market? Broker, commercial banks, jobbers and central bank. So which of the following is not a participant, the question is asking. So definitely commercial banks are there, central banks are there. Brokers are the individuals. They also available in every market, Hana? So they are there, but not the jobbers. Jobbers are not the participant of Forex market, because jobbers are those people who actually purchase any kind of product or service or any security in bulk, and then they sell to the people by charging a higher rate, Hana? So that's not allowed in the Forex market. So right answer will be your C option. Okay. Now officers batch already started. If you want to enroll, you can use a code Y496 to get the maximum discount in officers batch. And if you are going for any 3 subject or all the 4 subjects of JIB, then my suggestion is go with the JIB Mahapack. And if you are going for any 1 or 2 subject, then purchase the subscription batch of that subject. That will be much beneficial for you. And to enroll, simply download the Ready24/7 application, use the code Y496. You will be able to get the 81% discount, or in Mahapack you will be getting the double validity as well. Okay, so that's all for today. We'll be ending the session soon here, and we'll meet you again tomorrow with our PPB session only on JAIIB CAIIB English Medium channel. So see you tomorrow. Till then, take care everyone. Do not forget to subscribe the channel JAIIB CAIIB English Medium and press the bell icon so that all the upcoming sessions notification will be given to you. Okay, thank you everyone. Take care.